Hello, and welcome to this afternoon's Super Investor webinar on FinTech. My name is Joe Schorge. I'm the founder and managing partner of Isomer Capital. We are an investment fund focusing on a broad range of early-stage technologies, and the Super Investor team have asked us to bring together an all-star cast today to try to discuss a very broad topic that is financial technology, where it's going, where the smart money is investing, and if we can get to it, a little bit of predicting the future. I would like to turn to my panelists now and ask them to introduce themselves. We have two venture capital investors focused on fintech and one entrepreneur. Reinier.
Thanks, Joe. My name is Reinier. I'm one of the founding partners of Orange Growth Capital. We're a venture capital fund that focuses on fintech. We currently have 12 fintech companies in our portfolio and focus on what we call Series A investing.
Giles?
My name's Giles Andrews. I'm one of the founders and executive chairman of Zopa, which was the world's first peer-to-peer lending business when we launched it in 2005. And in most of that period, I was the company's CEO. And Reinier is a very smart investor because he's an investor in Zopa.
Thank you. And Mark?
I'm Mark Beeston. I'm the founder and managing partner of Illuminate Financial Management, and we are a purely capital markets fintech-focused VC, investing from our current fund in Series A and late seed fintech in the capital market space.
Excellent, thank you. Just a couple of housekeeping points for everyone on the call. You can submit questions throughout the discussion using the Ask a Question button. We will keep track of those questions and spend the last 15 minutes of today's session trying to answer as many as we can. Let me turn at this moment to defining fintech so we can get really a handle on a buzzword that's getting a lot of column inches in the press and an awful lot of activity globally. We at Isomer define it in a very broad way. We look at a lot of high-growth organizations that use technology and innovative business models to both enable and enhance and also disrupt financial services. But I'd like to turn to our panelists. Reinier, how do you define fintech, and what are the main areas that you're interested in?
Yeah, thanks, Joe. Yeah, no. So we define it very, very much on similar lines. So we look at technology, technology-enabled companies or innovations that are relevant for financial services. And actually, we're finding that a lot of the change and disruption, while it has a strong technology component, isn't necessarily only technology-driven, but a lot of it is business model change, right? So a lot of the innovations are coming through using the latest in technology to actually do something new in financial services, like peer-to-peer lending, which I'm sure Giles will talk about more later. The areas that we currently find very, very interesting are alternative finance, micro-insurance, KYC, so know your customers, which is a big headache. And we're also looking more recently at what's happening in the pension space. Because we think there's a lot of inefficiency and a lot of change there possible too.
And Mark, how do you agree or define fintech, and what are the areas you're focusing on these days?
Yeah, sure. Well, thank you. Well, as I said, we're almost a niche within a niche in that we focus on capital markets fintech, which is a slice of the vertical. One of my favorite observations is actually within the capital market space, calling it fintech has become such a fad, and it's conceptually quite a nonsense because pretty much everything is enabled by technology and the whole sector is fin. So fundamentally, we're a business solutions investor looking for problems in the capital market space, and the whole reason that we established the firm 3 years ago is that this is a domain that is full of problems, largely driven by industry deleveraging post the crisis, massive multi-jurisdictional regulation, and the fact that we are now operating in a zero-tolerance compliance environment. So for us, that really distills down to cost, control, capital, and compliance being the drivers of change within capital markets. And so anything that touches multiple of those gets us very excited.
Excellent. And Giles, you've built an amazing company in the peer-to-peer lending space, but it's over 10 years old now. Do you find yourself really focusing more deeply on that area, or are there adjacent areas, more broadly in fintech that you're looking at?
So we used to describe ourselves as a technology-enabled financial services firm, which is not really very catchy, and then someone came up with a rather shorter version called Fintech. But I agree very much with Reinier that this is actually about technology-enabled changes to business models. So technology per se, for its own sake, is not interesting in our space. And in fact, very few fintech players are using groundbreaking technology. They're using existing and efficient technologies to develop either a subtly or radically different business model. So in our case, peer-to-peer lending is an entirely new business model, connecting sources of capital with people who want it in a very efficient manner. And of course, we use technology to do that. But the technology itself, I don't think, is the interesting bit. Fintech players need to be good at technology, and in particular, they need to use the most agile technologies so that they can iterate and stay ahead of the game. But I think the fin part of it is just as important as the tech.
Yeah, that's a great point, and we have the same view at Isomer. In fact, we think what you've just described is great news for investors, because these days when you're investing in fintech, you're underwriting far less technical risk than you would have been in the past. You're really focused on business models and opening markets and delivering products, which is terrific. Let me turn then with some definitions firmly in place. It's a very wide area, but I think we have an idea of where we're all looking. Is it fair, let me throw out an idea, is it fair to divide fintech into two areas, one area being businesses and business models that support or collaborate with the current financial system, versus a second area of models and companies that are trying to disrupt it, trying to do the same services in a faster, cheaper way, or build more creative solutions to similar problems? Is that a fair distinction, firstly? And secondly, if you agree with that, what is the split of attention, funding, sort of number of companies, amount of activity that you see on those two sides? Maybe we start with Reinier again.
Thanks, Joe. I don't know. I think, when we started 3 or 4 years ago, this is very much how we sort of described the market. We said, there's companies that are enabling financial institutions, and there's companies that are disrupting financial institutions. And what I would argue is that over time, lines have started to blur. I think financial institutions are starting to disrupt themselves. They're starting to copy disruptive models from others. They're starting to partner with disruptors. So the distinction is becoming more and more difficult, I would argue. We recently looked, and we don't really have any specific numbers on the number of companies in each one of these sort of buckets. But the factoid that we did find that may be of interest is we found that roughly that if you look at financial institutions, specifically banks are spending about $200 billion a year on IT, right? And of that $200 billion, about 75% of that is going into maintenance. So one might be able to argue that the remaining 25% of the IT spend is going into something that is driving innovation, right? So something new in technology that would improve a customer experience or make things more efficient, etc. Now, if you compare that to the amount of money that's currently being invested in fintech, it's about 25 to 35 billion. So I would argue that financial services companies themselves are actually spending a lot to innovate in their own segment, and I think they should not be overlooked.
Yeah, important point. And do you see the interaction between large corporates who are building that innovation do you see the interaction with startups changing, growing, reducing? What's the trend there?
No, absolutely. We see a lot of collaboration between different financial institutions and the startups, and some are more successful than others. But the giants have been awakened, and they're not naive about this. I think it's actually made the whole space even more exciting because it's raised the bar for entrepreneurs.
Yeah, and we see in our own portfolio that it's much easier for a startup to engage a large financial institution these days to test their products, to run pilot programs, to really build their business in connection with the financial market, which seems to be getting easier year on year. Mark, turning to you, how do you think about this divide? Is it artificial? Is it real? And how are you playing it?
Yeah, so we characterize it in exactly the same way. We sort of broadly define the world in overgeneralized terms as sort of West Coast fintech, which we'll define as the retail-focused disruptors, peer-to-peer, crowdfunding, mobile payments, et cetera, and then the sort of the East Coast and major financial center driven sector, where it is definitely about enablement rather than disruption. One thing that I already listed are sort of 4 C's of cost control, capital, and compliance. One thing I tell my team all the time is that cool technology is not one of the C's. It's all about business solutions. And I think to your last point in terms of engagement with the industry, I think that was very well summarized in terms of the giants are awake. I do think that there is a little bit of a problem there, though, because at the same time that they've woken up, they're all doing very similar activities that actually add to the fintech noise, sometimes rather than helping to accurately cut through it. So you can count dozens and dozens of fintech accelerators or labs and heads of innovation, et cetera. It can be quite baffling for some of the earlier stage firms to actually navigate their way through that.
Yeah, on the sleeping giant question, I think what we see quite a lot is that most banks today have a strategy for fostering innovation, having an incubator in-house or partnering up. A lot of insurance companies are doing different things. Are you seeing, are those the main 2 categories, or are you seeing other areas of the financial world engage now?
We saw 6 different models ranging from equity taking accelerators, non-equity taking accelerators, consultant engagement models, corporate VCs, strategic investments, and the innovation function or innovation labs. So there are a lot of models out there. I think some better than others. Again, we think there's one sort of error here in terms of how some of the industry is looking at the space, because in many cases, I don't think it's actually about innovation. We see so much innovation, the number of companies coming through the door, 170 just capital markets fintech companies coming through our door in Q3, looking for Series A funding. The innovation's out there. The industry problem is validation. If you don't validate technology, it doesn't get adopted, and then the innovation dies. And where you're dealing with a corporate market, that's a problem. It's less of a problem if you're dealing in peer-to-peer, because individual purchase cycles are dramatically easier.
Yeah, and Reinier, I know you work a lot with major banks. Are you seeing other areas of the financial system get involved, or is it mostly about the banks these days?
No, so I mean, we see banks getting involved, we see insurers getting involved, we see pension funds getting involved, we see a whole bunch of adjacent industries as well, like accounting firms, etc. So financial services isn't only getting disrupted by startups and by incumbents, but also by adjacent providers that are saying, hey, wait a second, why can't we take a piece of that pie as well? So think about accountancy companies like Xero, or Quicken, etc., who have all sorts of interesting information, who could easily pivot into, or easily at least, maybe I exaggerate a bit. It's not quite that easy, but definitely have a competitive position, which would enable them to offer things like loans or other financial services, which would be attractive to their customer base.
So when you that's a wide span of activity. When you break all that down, where are the exciting opportunities? Where are you investing? The last couple of investments you made, or what you see in the coming few quarters?
Yeah, so I mean, we still believe very much in alternative finance. Specifically, what we're interested right now is in invoice finance and factoring. We think in certain markets like the U.S. and the U.K., those games have been played, but we think in continental Europe and in Asia, there's still lots of opportunities in those segments. We think micro insurance is really starting to take off. I think data is becoming available. I think through effectively digitally being able to serve customers, the barriers to customer service are decreasing. So you can start offering all sorts of micro insurances. I mean, a classic example of a micro insurance is something like, getting snowboard insurance if you're on your way to the on the way to the slopes. We're interested in KYC, which is short for Know Your Customer. Effectively, what Mark was also saying earlier, the compliance, the tolerance levels have gone down to effectively to zero. This is putting huge burden on financial institutions, but also on others, to be able to identify the counterparts in transactions. And this is creating a massive opportunity.
Yes, and the regulatory framework is not getting any more simple. So
exactly.
That's driving demand for better, faster services. Mark,
and I could go on.
I'm going to try to keep us on a tight timeline here. So let me turn to Mark. With your capital markets focus, where do you see the most exciting opportunities for you in the coming few quarters?
Yeah, well, thank you. I mean, it's definitely a number of the areas that Reinier already kind of pointed us towards. I mean, firstly, regulation is the gift that keeps on giving. Whether that's MiFID II, which breaks down into dozens, if not hundreds, of new problem sets and challenges. Basel III, CRD4, EMIR, GDPR. There are just so many opportunities, and again, when you're servicing the large institutions, there's nothing like a regulator holding a gun to the industry's head to really sort of focus the attention on adoption. I also think that we are now entering a new phase of market infrastructure. It's the main reason that we set the firm up. We've come out of a 20-year cycle of spending, all of those billions per annum that Reinier already mentioned on straight-through processing and trying to get the marginal cost of a transaction down to as close to zero as possible. In this deleveraging environment where volumes can halve, that requires an entirely new, different approach to cost, which anything you can think of as a service model allows organizations to now start to actually really index their cost base to transaction volumes on a declining basis as well as an increasing basis. So whether that's collateral or margin or risk or compliance or surveillance or best execution, et cetera, et cetera.
Mm-hmm. Excellent. I want to turn now to more the root level of the whole fintech industry, which is talking to a real entrepreneur. But before I do that, let me just remind everyone on the call, if you'd like to ask a question, we're moving along quite quickly, but please type your question in using the Ask a Question button, and we will address it near the end. Let's turn now to Giles. Giles, many people think that peer-to-peer lending is quite a new phenomenon, but actually Zopa is already over 10 years old. I'd love to hear a little bit your view on what is it like to start a fintech company today relative to 10 years ago, in terms of how much money it takes to get started, what sort of regulatory uphill battle you have to face to get launched. and the role of these large institutions and so on. Love to hear a bit then and now, if you will.
That's actually quite challenging to answer. So in some ways, being at the very birth of an industry, so we were the first people to launch a peer-to-peer lending business in the world, and also we're very, very early in fintech. Being early has some advantages in the sense that you can present a very big idea, and it's hard to challenge because no one has any data, so there's nothing really to compare it with. So in some ways, if you're being very brave and launching something entirely new and radical, that's the easiest time to raise money. Having said all that, the space has become a lot busier, and many more investors have come into the space. The alternative view to that is perhaps it's harder to come up with such radically new ideas, but there's a lot more money available and a lot more positive investor sentiment to the sector. So I'm sort of hedging my bets there in a way, saying sometimes it's easiest to raise your money into an unknown world, and other times it's easier given some familiarity with a broader set. So I suppose long and short of it, it's probably not any harder or any easier than it was 10 years ago. In terms of technology, I think that technology, it's a truism to say that technology continues to get cheaper year in, year out, and faster to develop, and it's easier to prototype things than it was 10 years ago. And there are some positives and some negatives in that. So you can today build a proof of concept much more efficiently, and therefore in some ways it is expected that you have done that before you raise money. In 2004, when we were raising money, we estimated it would cost us £1 million to launch the business, and there was sort of no minimum viable product between nothing and that. So therefore we had to raise the money before we could launch. So I think entrepreneurs have a little bit more pressure today, in the sense that they have to show something. And as soon as you show something, you then have to show some traction. And businesses often take off a little bit more slowly than optimistic entrepreneurs think they will. So sometimes it's actually quite challenging to raise money off the back of a working prototype, which hasn't got a lot of traction, and sometimes it's easier to raise it all effectively on the unknown.
So today's entrepreneur has to show more progress and more traction before they can raise.
Yeah.
If you think back to that million that you needed for the first product launch, is that £1 million today still?
No, I don't think it would be. I think it would probably be about £100,000. And some of the members of the founding team came into Zopa having launched Egg, which cost them about £100 million to launch. Now, admittedly, it was a bank, so it was more complicated, but it gives you an idea of how the technology costs reduce over time.
So Moore's law is in effect on the funding side as well.
Yes, yeah. But don't forget, the £1 million is just simply the technology cost. We raised £5 million because we wanted to have the working capital to run the business and employ people and market the business for a while. So the technology is only a small component, and the other part of the component I don't think has got materially cheaper. So it still costs a lot of money to launch a startup because of the going out renting offices and filling them full of people. Right,
and I guess the lowering of this barrier to entry means that where if you had to raise $5 million in the past, you would have had a few companies starting, whereas today you could have many entrepreneurs trying the same idea. What's your view on that? Is that a good competitive dynamic, or is that a false hope that too many companies are formed pursuing the same ideas these days?
Well, as an entrepreneur, I think I'd rather be competing in isolation against an established market. So back to your point about disruptors versus enablers. If we say B2C companies, to use an old expression, that generally start out as disruptors, and B2B players obviously have to start out or are enablers. So as a disruptive player, I think it's quite handy to have the market to yourself. Having said that, you want some validation. So it's great if you've got a head start and other people come along and validate your idea by competing with you. And actually, in many cases, they have some advantage in coming later because someone else has done the hard work of trying to change behaviours and make lots of mistakes. So often, hasten to add, not in our case because we were the first and we're still the leaders, but in many industries, the number 2 and number 3 players end up overtaking the first person. I don't think it's essential as an entrepreneur to always be the first.
Mm-hmm. And just turning to the regulatory question, I think you were fortunate, or maybe by design, built your company in an environment with one of the most forward-looking regulators. But we've seen that evolve a lot in the past 5-6 years. It'd be interesting to hear what you faced when you first started, and how that might happen today for a new entrepreneur.
Well, you're right in saying that the UK regulator, the FCA, is amongst the more forward-looking regulators in the world. When we launched, the FCA didn't exist. It was the FSA, which I think was slightly less forward-looking and was more of a traditional regulator. And I think the sort of classic startup dilemma is in a perfect world, you actually want to launch in as unregulated a manner as possible, because regulation just provides friction and cost to overcome. And so our trick, if you like, when we launched, was to work out how you could operate a peer-to-peer lending business without being regulated. And if you're correct in that hypothesis that none of the regulatory rule books that exist apply to you, then it doesn't really matter whether the regulator is helpful or unhelpful. And so our challenge was to navigate a route without falling foul of any regulatory rules. Having done that and successfully launched, that of course paves the way for other people to copy you and do the same thing. And it's all very well being unregulated when you are determined to do the right thing for customers, and therefore any lack of protection for customers doesn't really matter because you're doing the right thing for them. When people come along and copy you and maybe don't have quite the same standards, then you become concerned that other actors' bad behavior could impact on the perception of your business. So when we began to see people competing, some of whom looked pretty respectable and some of whom didn't, we actually ironically began to lobby for the regulation of our activity. And this is where the sort of forward-looking piece comes in, because by then the FCA did exist, and the FCA charter includes a statement saying that they will foster competition. Working with both politicians, the Treasury and the FCA, we eventually were successful and achieved what is still, I think, today the only purpose-built regulatory regime for peer-to-peer lending in the world. So now, of course, I sing the praises of our regulator. But I'm a fully paid up member of the club.
So, I mean, it's a great story because you essentially led the curve. You helped the regulator understand what was going on in the market and adapt. It could possibly have gone another way, where the regulator reacted badly and the business was at large risk. Have you seen that happening elsewhere, or do you see that coming?
I've seen that in the US, and that was part of the motivation. So the people who copied us first in the world were in the US, and there were two leading players. And one launched in 2006, a company called Prosper, and another in 2007 called Lending Club. And they operated almost exactly the same model we did in the UK, but under US regulation, that activity was captured by the SEC because it was deemed to be the selling of securities. They tried to ignore that and sort of launched under the radar and hoped that people might argue the regulation didn't apply to them. But the regulator decided it did and shut them both down. So that's really, that's showing how regulation can act severely against the interests of a startup, and they had to modify their business model to then accommodate the regulation, and today, to this day, operate under a regulatory regime which is manifestly not designed for them. The selling of securities legislation was created in the 1930s as a result of the Great Depression, and people selling securities in dodgy companies, not selling loan notes. So for us, that was a salutary lesson that if we didn't get ahead of the curve, there was a risk that some piece of regulation that we hadn't thought of could be used to challenge our fundamental business model. So somewhat defensively, we thought, well, let's at least try and play a role in shaping something that fits the purpose, and if it can provide some consumer benefit as well by virtue of some protection to consumers, then that's a very good thing. Now, other places in the world, in continental Europe, in France, the Bank of France applies some, we would argue, inappropriate regulation to the sector, just because it exists. It's very hard. If a law exists, it's very hard for any regulator to ignore it. And I suppose the lucky situation was in the UK, we could find a way through that meant that none of the laws that have been written here before applied to our activity.
Fascinating.
To answer your question, yes, I have seen it go badly wrong, therefore, in several places around the world.
And there's a very clear lesson there for every fintech entrepreneur. If you're not thinking about regulation and not involved in regulation, then you probably have an unknown risk there that you may be able to manage better. Just finally, on the entrepreneurship side, love to hear your observation of how large financial institutions were engaged at the start or are engaged today. I mean, do you see them as playing a role of competitor or customer, or are they testing the product themselves? Or and again, a bit of 2005 and a bit of 2016 would be interesting.
So I think when you launch a B2C play, you tend to define yourself by what you aren't. So if it's a new behaviour, so peer-to-peer lending, we're asking people to do something they've never done before. It's very hard to describe yourselves in terms of what you do. You tend to describe yourselves as what you're not. So we position ourselves very firmly as not a bank, therefore in competition with banks. And I think that helps people understand what we do. Now, over time, as we become more confident and comfortable describing what we do and describing the strengths of the business, so, for example, we've developed very, very strong credit analytical skills and run an extremely successful credit management business. So once we build up a track record, we can start talking about that, and that's altogether less sort of combative, if you like, with the incumbent players. Mm-hmm. And then we can start thinking about, well, if we have a clear area of superiority against incumbents, we can compete with them, but that's hard, actually. They make a lot of noise. They've got lots of existing customer relationships. But if we've got a demonstrable track record, then we can show that track record to them and try and work with them. So in 2005, there was no way if we rocked up at the office of Lloyds Bank and said, we're really good at risk management, would you like to let us manage parts of your risk book? They would have laughed in our faces. Now, if we go in 2016 with 11 years track record and a demonstrably better performance than they've achieved, then they're going to be very open to the conversation. So we've earned the right to collaboration, I think, and we've grown up insofar as we recognise the benefits that collaboration can bring. And its customer acquisition is tough. And as a thinly funded startup, going head to head in the marketplace is tough. But demonstrating what you can do, what you can bring to a partner, and collaborating with them seems to me to be a very efficient way to grow. But you can't do it on day one because you haven't got anything to sell.
So your view would be the willingness of the large financial institutions to collaborate is less to do with their general openness and more to do with what you can show them in terms of progress.
Well, I think it's both. So I think just the passage of time and 10 years and the noise about fintech and lots of commentators telling them that they need to collaborate focuses their mind as well. So I think it's both. I think they've become more receptive and we've got more we can show.
Excellent. Turning now to the funding environment, and it's great that we have someone on the line who's funded you, Giles. We've come now to the stage where a lot of people feel there's an awful lot of hype around fintech. There are some specialist firms investing. There are a number of generalist firms dabbling, and lots of people coming in. Fred Wilson, who's a real thought leader in the industry, recently said that the dumb money has shown up now, and that's a bit of a warning signal. Reinier, what's your view today on the venture capital environment in fintech? Is there too much hype? Is the hype aligned with the opportunity set that you're seeing? Have we, coming back to our title, have we missed the boat, or is the boat still headed out?
Yeah, no, I think, it's hard to deny that there's a certain degree of hype around fintech, right? There's a lot of capital flowing into fintech, as I said earlier, both from the venture community and the investment community, and also from financial institutions themselves. So there is a lot of money going into this. There are specific areas which I think have been clearly overhyped. I think Bitcoin is something that I would point to as being something where the expectations were far larger than the reality of that. Although I'm sure that there's some that would disagree with me on that, but I think that's a clear example of something that was overhyped and disappointed. But that being said, I think that people sometimes underestimate the scale and the scope of financial services globally. I mean, we estimate that it's about 30% of GDP. It's a massive industry, and it's clear that it hasn't gone through the degree of change that other industries have gone through. And I think now we've embarked on a period that will last at least for the next 10 to 20 years, where we'll see financial services just change dramatically. I mean, to point to maybe something that's going to happen in the very near future in Europe is changes around PSD2, right? That's a regulatory change which will allow you as a consumer to give third parties access to your bank account to get transaction information in and out of your bank. I think that is going to lead to another big wave of for lack of a better word, disruption in financial services, where there's a real risk that banks become utilities, and then a lot of the front end interaction gets taken over by either existing digital companies like the Googles, the Amazons of this world, or new entrants, new startups. So coming back to your question, is there hype? Yeah, there's hype, but is the hype
a lot of opportunity
probably,
as well?
Yeah.
And how is the funding that you see today? Is there, relative to the opportunity set, is there too much money coming in now? Not enough? Where are we in that cycle?
No, what I would argue is there's a good amount of professional money in. What we are noticing, and maybe this is just a personal thing, but what we're seeing is a lot of the angel money, right? So the non-professional money, especially at the early stage, seems to be increasing quite dramatically. And there, what we're facing at times is that there's angels that are putting money into companies and actually really driving up the early stage valuation on a lot of these companies. And in reality, that makes it quite difficult because they underestimate how long it will actually take to get the company off the ground. And by starting off with a relatively high valuation, it's difficult to, keep investing after that high valuation. And so especially at the early stage, I think that there's a little bit of an overinvestment. I think once you get post Series A, I would even argue that in some segments there's an underinvestment.
Mm-hmm. Mark, the companies you're backing these days, are they overfunded, underfunded, how struggling to find capital? What's your view on that supply-demand balance these days?
Yeah, so I think there's two interesting edge cases, and Reinier has already drawn attention to one. I think the only place that we've lost, potential deals that we want to do is exactly that situation, because capital markets does create, possibly too many, ultra high net worth angels with relatively limited deal flow. So there's a distortion, definitely at the angel space. The other place where there's distortion is blockchain. We strongly believe that blockchain will make a contribution to the industry at some point, but today no one knows where or when or how. But an influx, particularly of bank capital into that space, seems to mean that every blockchain company gets valued like the multi-billion-dollar savior, and we just don't see good risk reward compared to everything else. I think then for the vast majority in the capital market space, capital markets is probably underfunded still compared to the more disruptive end of fintech. It's a relatively small amount of the capital that's getting allocated there, and I think one of the reasons for that is that in many cases, the super successful VCs that have raised their 11th $500 million fund really struggle to deploy capital in the space because this is a consolidation-driven landscape rather than a billion-dollar IPO-driven landscape. So, if you're searching for unicorns, you might find them in retail. You're not necessarily going to find them in capital markets, where there's just a preponderance of dragons, but not too many unicorns to be found.
Mm-hmm. Just finally on the venture capital side, before we move along, I think most people are aware of where the main hubs of fintech activity are. Just a quick question to all of you, really. Several countries now are setting up sandboxes, if you will, or regulatory environments where you can try new models in a fairly light regulatory regime. The UK, Canada, Australia, Singapore. Are you following these initiatives, and do they make these jurisdictions more attractive for you as investors, or is it really more driven by single companies? How do you view that phenomenon, Mark?
We certainly follow it. We're in close contact with an awful lot of organizations around the industry, whether they're sandboxers or our strategic partners, at the banks, who again often have their own, innovation type sandbox environments. They're super useful in terms of again helping sort of expedite the early stages of the companies in terms of access to problems, access to data, et cetera. What I think they all struggle with is still getting companies through the next stage, which is the painful procurement cycle with large institutions. So at the end of the day, you still have to come back to, is this an interesting company solving a problem, and is the problem a clear and present one that has to be addressed now? So they can only go so far.
And Reinier, you're active in multiple fintech hubs. Is government a factor for you or not?
Yeah, sure. It helps. I mean, the way we sort of think about it is we're just looking for the best entrepreneurs, right? So at the end of the day, the company is a success based on the entrepreneurial talent that's running it. And so for us, these sandboxes sort of, for lack of a better word, serve as a water hole, right? And they drag all the entrepreneurs into a single place where they can experiment, et cetera. And it helps us actually find entrepreneurs easier than we would otherwise. But they don't create innovation, and they don't, and it's unproven yet whether they'll accelerate it. But it's helpful.
Excellent. Just looking ahead quickly, we need to exit our investments. And we've seen some good exits, but hopefully a lot more to come. Within the fintech space, are we likely to see more acquisition activity or IPO activity? Mark, you expressed half an answer to that. What's your view?
Yeah, so when we put our PPM together, we actually tracked the exits in the space over the prior year for our capital markets domain focus, and it is unquestionably a consolidation-driven, M&A-driven space. I think market is probably the standout, multi-billion-dollar IPO in our space, but we tracked 200 consolidations, 200 exits to 153 different acquirers over the 3-year period prior to us launching the fund. It's vastly consolidation-driven activity.
Mm-hmm. clear message there. Let me just turn, before we open up for questions, a quick fire round of a few big trends that are on people's mind. Love to get your very quick opinion on a few things. Reinier, what's happening with challenger banks, and where do you think we're headed in the challenger bank area?
Yeah, I mean, Joe, to be blunt, I'm just not believing it. I don't see what the substantial benefit is that the challenger bank is delivering over what many of the incumbents are already delivering. I think, yes, they might be a little bit faster with bringing new technology to consumers or SMEs, but in reality, financial institutions, as I said earlier, are no longer asleep, so they're catching up quite rapidly. So it's not an area that we're actively looking into.
I'm side of that. Lots of activity in the robo-advisor space. Some recent announcements from large institutions. How do you see robo-advising evolving?
Yeah, and sorry, I want to avoid that. I'm not seen as a pessimist, but I think I love robo-advising, but I think it's an incumbent play. And I think Schwab and Vanguard in the U.S. have demonstrated that. I mean, they opened up robo-advising services and that basically overnight overtaken Betterment and Wealthfront. And I think basically these robo-advisors have come out and they've taught financial institutions what they need to do to serve the mass affluent segment.
Yeah, and a lot of the ones dressed up as robo-advisors over here aren't robo-advisors anyway. So I find quite challenging.
Yeah, well said. Yeah.
And Giles, moving to you on peer-to-peer models, where do you see, clearly a lot happening in lending? How do you see that evolving in insurance, banking, other areas?
Well, you're right. You're seeing a lot of new lending models. Basically, if you think of every asset class that banks lend into, then you're seeing that being replicated in peer-to-peer. So we're consumer only. You're seeing SME only players. You're seeing property lending businesses. You're seeing invoice discount lenders, and you're seeing some people who even try and do a bit of everything. So you're seeing a big proliferation in the lending space. And to me, that sort of makes sense because ultimately the one side of the balance sheet is entirely fungible, i.e. it's money, and it can sit waiting for transactions to happen. I think where peer-to-peer gets a bit more difficult is in some of the other spaces that make noise about it. For example, in the currency space, where it's used as I think as an effective marketing tool, but clearly it isn't peer-to-peer because peer-to-peer doesn't work. Because if I've got euros and you want dollars, then that's not much use. There needs to be a sort of more immaculate conception around the time of the trade, whereas money can sit waiting because it's always the same. Whereas currencies are obviously much more different. And I need currency now because I'm going away for the weekend rather than being able to wait a few days for it. And in the world of insurance, I think the challenge with insurance is that the provider of the promise is really important. So if I'm lending money, my money is as good as anybody else's. So whether if I'm a retail lender on Zopa or if I'm one of our institutional lenders or Metro Bank, for example, then all of our money is the same. In insurance, you're buying a promise in the future. So if you take a really strong one like your house or your life, you're buying a very important promise in the future. And I'm just not convinced that people will be happy accepting that promise from a peer because the quality of the promise is materially different, whether it's provided by me as a consumer or whether it's provided by Legal & General, whereas my pound is the same as Legal & General's pound on a lending site. So I think the insurance model is therefore much more challenging. And I mean, I'd be interested to hear Reinier's view on that because I know he's interested in the space. But I think it's harder to get consumer adoption with a peer-to-peer promise for the future than it is in the lending space.
Excellent, thank you. Let me go to some of the questions now. We have an inbox that's overflowing. Some great questions. Lots of people interested to hear from the panel about valuations. It seems like valuations are rising in the space. Are you comfortable with valuations where they are today? And maybe if you can put a little color on regional differences. Mark, would you like to field that first?
Yeah, I think it's a really great question. I think if you'd asked me that question 6 months ago, you'd have probably got a slightly different answer. I think we've come off the highs. But again, I can only speak for the capital market space that we focus on. And one observation that I will make there is that both the initial capital check sizes within the capital market space and the initial valuations within the capital market space seem to me to be materially lower than in the more disruptive retail facing side. And I think that's a function of two things. I think generally speaking, less capital chasing the same deals, but also what I spoke to about earlier, which is that the exit horizon and the exit methodology and price levels are very different here. You're not going to find too many 1,000 X's within this space, and that gets priced all the way down to the front end.
Mm-hmm. Reinier, how are you feeling about valuations these days?
Yeah, so I completely agree with Mark. I think if you had asked the question 6 months ago, I would have said, we're at an all-time high. I think, over the last 6 months it's gone down. I think specifically, with the pound dropping as much as it's done, it's made the UK a lot more attractive. So we were typically seeing that even within Europe that, even though everybody was high, UK was even higher. And I think that's now become a little bit more realistic. I think outside of Europe, I don't really have a good view on the US, to be honest. I think they tend to raise more, but they raise at higher valuations, but they also raise more. So it's more difficult to compare. I think in Asia, we're seeing that the valuations, especially in Southeast Asia, seem to be relatively realistic. For us, valuation is rarely an excuse not to invest. Usually, as a venture capital firm, we can create a structure whereby we can overcome some of the valuation differences that we might have with an entrepreneur and still get the deal done.
Mm-hmm. Excellent. We have another group of questions around exit activity, one particularly about alignment with management teams. Can you comment on how easy it is you find to manage an exit alongside the management team, given how time is compressed and people are expecting payouts more quickly than ever before?
Would you like me to pick that? Yeah.
Yeah.
So I think that I think what we're doing in exit situations with our entrepreneurs is, ironically, what you do is you work out an entire structure with all sorts of legal clauses, etc. But in reality, when you get into exit mode, everything is fluid again, right? And so what we try to do is based on what type of exit we're doing, we try to really sit down with the entrepreneurs in advance and think about what is the structure that will work for everybody around the table, so that they're motivated not only to sell the company necessarily, but also to make sure that, once the sales happen, that it's been a success, right? So that they're willing to stay on board with the new company. And at times that means that, you might not get the highest price that you could have gotten in the market, but you need to do that to make sure that the entrepreneur's on board to make sure that the exit happens successfully with the earn-out.
Mm-hmm.
If I could actually just pick up on that, I mean, I 100% agree. I mean, exit alignment is created on the way in, right? I mean, there's just no doubt about that, right? And part of it is deal structuring, and part of it is as simple as actually sitting down, having a proper conversation about not just where the company's going, but where the individuals behind the company want to be. Because if you think it's a great opportunity, but you're not owning a majority, and the management are going to sell out the first time they get a sniff of a life-changing $10 million check, it may be a great opportunity, but one that's just not worth following.
And that's something really to be assessed long before you make the investment.
That's exactly right.
Yeah. We have some people wondering about the low interest rate environment, both on the opportunity side and on the risk side. Do you see low interest rates driving a particular opportunity set or creating a particular risk? Mark, would you like to try that?
Yeah, sure. I think it's for us. I think it's less about the low interest rate environment and actually more about all aspects of the capital environment. So a far bigger factor for us is the squeeze that has been placed on incumbent financial institutions' balance sheets by migration towards Basel III or CRD4, et cetera, et cetera, et cetera. Clearly we're in in lots of assets we're in a QE-driven low interest rate bubble. Again, I think some of that was reflected in fintech valuations 6 months ago, and some of the air has been let out of that. That would be my observation.
Giles, one for you. People are picking up on your comments earlier that the peer-to-peer lending's grown very well in the UK, somewhat in the US, in China. However, it doesn't seem to be taking off in the Nordic markets, or even some larger markets like Singapore. What's your view on it? Where's that headed? Do you agree with that assessment? And
I don't know about Singapore, but it's growing very well in the UK and the US, and I think that's because we have large and liquid financial services markets, so consumers understand borrowing money, and there's a wealth of data to allow new players to come in and compete with banks because they effectively can use the same data that banks can in making lending decisions. So I think where it hasn't taken off is for one of a variety of reasons. It could either be that there isn't sufficient credit data, and therefore you can't give your investors an informed choice, or you're not effectively giving them information about the risk they're taking. That could be one reason. Another reason could be regulation. So, for example, in France and Germany, both big markets, regulation is unfavourable and requires some kind of banking license in both countries. Or thirdly, in the case of some of the Nordics, they're just quite small markets. So you've got early adopters of new technology. People like using the internet. They like using mobile phones. You may even have good credit data, but you simply don't have a big enough market to allow for the fixed costs of operating a business like this to be covered, because the costs of operating a business here are not very different to the cost of operating a business in the Netherlands or in Norway, in terms of the people, the functions you need to fill. And in a very small market, it's very challenging to cover those costs. So I think it's one of those three reasons would mean that the market doesn't take off. So it's either regulation, or it's lack of data, or it's the market's too small. In the case of China, you're right in saying it's taken off spectacularly. There are 2,000 peer-to-peer lending platforms, but it's taken as a sort of poster child of how not to do it, in the sense that it's completely unregulated and it's very Wild West, and you've seen some appalling scandals. So there was an $8 billion fraud, not 8 million, $8 billion fraud relatively recently, where people were effectively running a gigantic Ponzi scheme, pretending they were doing peer-to-peer lending and giving a bit of money back occasionally to investors if they offer it back, but by and large siphoning it off, and have now been caught doing so. So that, I think, there's a lot of scandal coming out of China because it's a completely unregulated activity.
Mm-hmm. Thank you. Reinier, someone's picked up on your comments about angel networks and how they're affecting the early stage of the market. Someone's noted that these are unregulated entities, the angel networks and the business angel clubs that are doing quite a lot of investing these days. But there seems to be an increasing volume of deal flow that does fall under regulated activity. The question is, how do you see that landscape evolving over time? Maybe more or less angel activity? Will it professionalize? Is it really tourist money that goes away in the next cycle? Do you have a view on that?
Yeah. Well, let me start by saying that, for us to be successful as venture capital firms, we almost rely on an angel network, right? Because it's usually the angels that are the first to give money to an entrepreneur who comes into their office, effectively with an idea, and that money is translating that idea into a product. And that's the point at which when we can invest to make that product into a real company and scale that, etc. So there's actually a very beneficial relationship between angels and venture capital, and it's a critical part of the ecosystem. And I would even argue that, you know, in certain ecosystems, one of their fundamental issues is that they don't have enough angels. And so by building out the angel network, that's actually the fundamental first step to drive innovations in those markets. Now, that being said, yes, you actually do see a lot of angels with varying levels of professionalism. At times, there are some angels who have been very successful or who are ex-entrepreneurs who've gone through this number of times themselves and actually do know what they're doing. At times you don't. And I don't expect any changes there. I think the one big thing that is changing is obviously crowdfunding, right? So you're seeing a lot of groups that are coming together and they're finding investment opportunities, and a number of smaller investors can join and get an equity stake in a startup. Now, our view on that is that we actually feel that that's relatively dangerous. And the reality is that our expectation is that a lot of those sort of retail investors, well, yes, there's now a regulatory framework around it, but a lot of them actually don't really understand the risks. And as soon as, you know, certain segments start collapsing or they start writing off these investments, there could actually be quite a big backlash from the retail investors who might argue that they didn't read the small print. And then the question is how are we going to deal with that? So I think we need to wait a little bit longer there.
Yeah, if I could just pick up on one thing that Reinier said there, you know, I mean, firstly, you know, he's 100% right about us relying on it. I think the thing that has changed out of crowdfunding is that angels aren't just coming before the VCs now. In a sense, they're coming afterwards as well. When a company does the rounds and none of us decide to invest, you see them pop up on crowdfunding. Right now, you know, obviously we're in the business of, you know, occasionally missing fantastic companies, but, you know, crowdfunding is becoming a clearinghouse for things that we think are unfundable. That is very dangerous indeed.
Mm-hmm. Yeah, because I think the VC market is pretty efficient. So I'd echo that.
Thank you very much, gentlemen. I'm afraid I have to draw a line under it there. We've reached our time. Let me thank the panel for your insightful comments. Always a wonderful discussion with you guys, so I really appreciate that. For those who enjoyed this conversation and would like to continue it, we will be at Super Investor in Amsterdam on November 15th and 16th. On the 15th, there will be an entire day of this sort of discussion covering various technology sectors, various stages of investment with a focus on tech hubs. I think it will be a fascinating day, so come and join us. Also, if you'd like to play back this session, it's available on superreturnlive.com. You can replay this and other sessions there. There's a lot of good information there. And that's the end of our webinar. Thank you so much for joining, and see you in Amsterdam.